Without further ado, I would like to now give the floor to Egita. She's the general partner of Outlast Fund, one of the new Altum funded funds in Latvia. And I guess you can introduce more about yourself as well. Yes.
Thank you. I'm actually coming from a VC world, so it's a bit different, but we're a very early stage VC, so technically we're investing in the same stage as the business angels. So hopefully whatever I'm telling you, you can also use when you are evaluating startups. But a bit about myself and my experience, and please ask, the first thing, please ask me any questions if you would like during the presentation, during don't wait until the end, because I think it's nice to have a discussion, and it's all about sharing experiences, because as you will see in the startup evaluation, there's nothing fixed, and I actually did stalk a little bit of your backgrounds, and I know most of you are very experienced, but you are experienced also, I saw, with a lot of numbers, with a lot of predictions, and startup world, and especially when we are investing, at best, there are 3 founders, 2 pilots, and nothing else. And you still have to make a decision how to invest. So I will be focusing on that side. So currently, as Emil's introduced, I'm one of the founding and general partners of Outlast Fund. We are a very fresh VC fund created here in Latvia. We're 4 partners. 2 of us are here in Riga. 2 of us are in Stockholm. So we have a Nordic relation as well. We just closed in the summer our first fund in this setting, and it's 21 million. Altum is one of our main LPs, but we also have investors from Baltics and Nordics, like business angels, investing in our fund. Also, LatBAN is one of the investors in our fund. And so currently we already have 6, since summer we have 6 investments. 2 are in Latvia. 1 is in Sweden, 1 is in Norway, and 2 are in Estonia. And we are currently reviewing more investments, and I think in a couple of weeks we'll have more. So we're quite active in the investment, and we aim to have around 30 to 40 companies invested within our fund for the next years. Previously, my experience has been for 10 years. I have worked with a lot of startups, mostly on the early stage, acceleration and investment side. So for 7 years, I worked with Startup Wise Guys, which is an early stage investor from Estonia. With them, we expanded over all Europe. I joined them when we were 5 people. When I left, we were 70 people. And before that, I also worked with Techstars, which is an early stage accelerator in US. So I spent 2 years in Seattle working and seeing how they invest and how they work with the startups there as well. So a lot of pitch decks reviewed, a lot of startups seen, and I worked specifically also with them in the acceleration program. So it's pretty much once we made the investment decision, we worked with them for 3 to 5 months and helped to raise the next funding round. So I participated in more than 15 different acceleration programs over the 10 years. So quite a lot of startups seen, and a lot of, let's say, successes and a lot of failures as well. But yes, that's it about me. I assume I just click and yes. So today we will talk a little bit more, as Emil's kindly asked me to tell about the kind of introductory session. I focus more on the startup lifecycle, funding processes, different funding types, also a bit on the startup evaluation. So how you start looking at the pretty much startup pitch decks. Where do you start? What kind of questions you need to ask? How do you think about evaluating, and how do you make the decision? Then there will be a bit more practical session on the investment types and portfolio creation basics. I'll touch upon that very briefly because I know Ansis is coming talking about that more in detail, and I think you also have like proper due diligence session later. So, but maybe before I start, because again, this is kind of very general presentation, how many of you have already done the investments in startups? 1, 2, it's like very shy hands. 3, 4 I saw. Really? Okay. But have you reviewed any, let's say, startups already? How many of you have looked at the startups? Yeah. Okay, you have seen a startup, that's good. That's a good start. All right, good. So some experience. I know some of you, like you who raised the hand that you have invested in startups. I would really appreciate if you have any questions or comments, or you agree or disagree, or you actually experience the thing, like whatever we're talking about, and you experience that while investing or evaluating. Please share, because it's there's no right answer how to evaluate startups, because at the end of the day, we don't really know. We can make assumptions, we can make educated guesses once we have more information. But then from my own experience, like when I look back at the 10 years, sometimes when the unexpected hits, and unexpected can be very different things, external, internal factors, even the most successful startup can just disappear and go to bankruptcy with all the investor money. So, but yeah, a bit scary. Maybe I shouldn't have stated that at the very first session. But okay. Emils, if I'm talking too much, maybe wave at me so I can, because I have a lot of slides. You probably have seen this. Hmm?
Yes, you will get, yes.
Yeah, you will get the presentation. So I wanted to start maybe just a bit about the kind of, I don't know how many of you are familiar with this, but this is sort of up. There is the startup sort of life cycle when they start with the idea. Then there is team formation, MVPs, minimum viable product or prototype, launch, users, revenue growth, and this is something that everyone hopes to get. And usually the funding, like this is kind of for already when they're profitable. Private equity, banks, this is where the numbers live. This is where it's, let's say, easier to evaluate. Here, there's a lot of assumptions. And usually everyone starts with either their own capital savings, the famous FFF, which is family, friends, and fools. That's like famous investors in the startup world. And then there are different incubators, grants, support programs. I used to be in the accelerator space for a while, and I would say this is where the business angels, accelerators, and venture early stage funds come in to provide, like you can see, basically business angels can come also in at the very idea level, but that's your, let's say, comfort level if you are comfortable investing in just an idea, or usually they go up to the first revenue. The same with accelerators and the venture capital. Then there's, like, for example, our fund, Outlast, is pre-seed and seed. So pretty much when we are one of the first investors, we can follow up in the second round. But after that, we just don't have, let's say, when the rounds are bigger. Our biggest ticket is 1.5 million. But that's something that I don't think we will use with the size of 21 million fund. I think our average biggest ticket would be like 500,000, 600, 800 as a follow-on, or...
So you have 40 investments to make, right?
Approximately, yeah. And yeah, we are 5 people now.
And you manage 40 accounts, right?
Well, we'll see. But now we have 6. But yeah, technically, when I was working with Startup Wise Guys, for example, it's a bit different. Then we made like 10 investments per program. And then, for example, in one of the recent years when we were growing quite a lot, there could be like 10 programs per year. So it could be 100 new investments coming in. I think when I left, Wise Guys had like a portfolio of 500 companies, but the team of 70 people. And again, and that's like when they come in, it's quite a lot of like a program work, and then they're sort of on their own. With the VCs, it's a bit different, and I think with the business angels as well. So you also have to manage, you have to understand how much time you can actually dedicate. So ideally, how we did with the accelerator is like you kind of already start seeing the 3 categories, which is those who are very successful, most likely don't really need your help because they just need money, support, and then they're off. Then there is like those who are most likely already like you invested, but after a year you see nothing's going to happen, or they go to bankrupt. Then you already kind of disregard sort of those because you can't help them. And then there's the middle part. And that's a bit of, you never know. Sometimes you need to help them and they will succeed, sometimes they will not, but they usually require a lot of support. But yeah, this is kind of understanding where you're kind of coming in, because I think it's important. And well, technically, business angels can also invest here, but usually when the rounds are coming here, they're super expensive, the valuation is high, and also the startups, for example, there are like in the bigger rounds, they say the minimum ticket is 1 million, 2 million. So even for us as an early stage fund, we couldn't always follow up in this part. But I think this is kind of the most important also stage, because, well, don't yell at me because I know you have more experience, so I think most of you here, but I think this is like the part that can actually make it or break it, because to get to here. So it's super important. Yeah, so these are the same investments. How usually, well, this is kind of from the, I guess, from the startup perspective, because technically startups also have to choose investors, and I think this is also how you need to look at the startups. Because we also, as a fund, for example, there are specific stage or product type or business model, geography, startup needs, industry, and also risk averseness, for example. If you don't want the risk, most likely then the corporate investments or something is more for you. If you love the risk, well, then you can go to the idea stage. But it's also, I think, when you choose the startup, I guess think about also these things. Are these important to you? Can you help the startup? For example, business model. For our fund, we mostly invest in business-to-business model type. Because in this region, business to consumers, B2Cs, well, it's harder to make. And also all four of us, the partners, we don't really have the experience in B2C. That said, we technically did also, one of our 6 investments is in B2C, but that's more like an outlier, and we check if we actually can help the company or not. Or the same with industry, for example. You will see that, well, you all have experience in certain industries, you have certain expertise and skills. And I think it's important to look at the industry you know, but then when we go to the portfolio creation, it's also important to diversify. So it's, there are 2 things. But yeah, so I will not maybe stay too much here. I don't know if you have any questions, comments, thoughts?
Is there any pressure from the partners of your fund in terms of, I mean, what kind of returns you have to generate, or in your like quasi with state-sponsored scheme by Alton, so you have lowering of those standards? Could you kind of brief on that?
Yeah, no, we can actually, so there is a specific, let me say how to start. There's no, we are definitely, I guess, not lowering the needs, because for us it's also important, we don't want to, let's say, rely on Altum's money for the upcoming funds, and to be able to raise the next fund, we actually need to get the returns with the market standard, because otherwise, what's the point? And for other investors, they basically, it's like the same with the startup. I always say, like, the first, you can sell the idea on basically on the vision and your expertise, but then later you actually have to prove the traction. So we are aiming for the sort of the market standard. Market average currently, I think if the fund in general returns 2.5x or above, it's counted.
That's within 5 years, or?
That's in the fund life cycle. So we have a 5 years investment period, and then 10 years is the fund, let's say, life cycle. So within 10 years, we have to somehow return back the money. And then usually how for the investors is first we return paid in capital, then we have an interest rate that is on top of that, and then we share, let's say, distribute the profits. And well, for our fund, technically, it is the good part. That's also was part of the tender process that, let's say, government doesn't want. They want back in the paid in capital. They want the interest rate, everything rest, that it's distributed among partners and the investors. So, but that's pretty much we are 3 funds, Outlast, Bad Ideas, and Build It. So everyone could suggest their own, let's say, distribution afterwards.
So 2.5 times, that's approximately like 20 to 25 IRR, right? Something like that.
Yeah. We'll have some numbers later as well, I think, for the, but that's actually a good question, because why I'm also kind of, I'll talk more about the evaluation, startup evaluation process, but then at the end, when you talk about the evaluation, about the terms, negotiations, I think the angel portfolio, and for example, for us, the early stage VC fund, at the end, it doesn't change that much, because we are going, you'll see I have some numbers. Basically, there can be some startups will return 0, some startups will return a lot. And then the average is something that you're aiming for. And of course, which way you're skewing more returns, then the more successful you are. And, but there's quite a lot of things that come into the play, you know, the hypes and trends, and of course your ability to evaluate, because at the end of the day, the more startups at least generate like decent amount of returns, the higher the average will be. So, okay, this is easy. Now we will start a fun part. So how to evaluate a startup. So this is, as I said, like I'm usually actually telling this part to startups to tell them what they need to include in the pitch deck for investors to receive all the information. So now I'm actually telling it to other investors from the different perspective. But yeah, before we start, this is actually a couple of numbers. These are from 2019, and I will show you also the more recent ones. Well, this is from different sources, so take it with a sort of grain of salt, but approximately that's how it is. So why startups actually fail? And I think this is important because, of course, half of them build products that market doesn't actually need. 29, almost 3, like let's say 1/3 failed to raise capital, and the third one, I don't know if you're surprised or not, but team issues is also one of the biggest failure rates, and that I experienced from my own experience during the acceleration programs. We've seen teams with the co-founders who even knew them each other from the childhood. A couple of years into the, let's say, business, they decided they need to go into 2 separate directions, and if there are no clear mechanisms how to actually work on these disagreements, it can destroy the company. And in the early stage, it's super important that you, at least for us, we always, as an accelerator, and also now as a VC, we look at the deals very carefully to understand how we can, let's say, implement different mechanisms to protect us, but also to save the company. But yeah, you know, the others got outcompeted. Unit economics, this is also a very important part that I will show in the evaluation part, because you would be surprised how many startups actually come with the numbers, with amazing idea that they love, and I truly believe that they love it, but they've never calculated how many customers in total they go for a super niche industry, and then when they actually check how many clients in Europe in total they have, and then they pretty much multiply it with the monthly revenue, there's nothing. But yeah, so that's also something you can evaluate. Flawed business model, poor product, no chemistry, lack of passion. That's also important, I think, because at the early stage you invest in the team. These are the numbers more from 2024, 25. So startups have gotten a bit better on the market need. That's good. However, a lot of them actually failed to raise the capital for different reasons. And that's also, I think, it's important to understand when they come to, and there could be different reasons as well, but I think it's also sometimes they just miscalculate how much money they actually need and how long is the runway. And sometimes they just raise a little bit and they don't achieve their goals, and then they just can't raise the next round. And I think that's also for you as investors to understand, if you give them the money, that you kind of provide this long-term planning, because for us as a fund, maybe it's a bit easier because we can always provide some bridge rounds, for example, if everything goes, well, too south. I had to think about what is the right word to say here. But I think for you as a business angels, it's also not always you have an ability to follow on or do a next round. But then you need to understand if there's someone who can do it. Well, they have gotten actually better on the team issues. Competition, unit economics is the same. I think here the numbers, well, they also have improved on the product side. So I think with AI probably and everything else, it's not that, and with a lot of competition, that's also improved. But there is a new player. So it's regulatory and legal challenges that actually has come in for almost fifth, like almost 20% from the reasons why they fail, they actually experience this. Which is interesting, and I think that's also something that you as an investors have to take into account when you evaluate them. Are they going to run into these problems or not? Yes, this is it's always a unique idea, but it's not. It's an excellent execution. Which is actually true. Like I've seen a lot of companies saying we have this lovely idea, but without the execution, it's completely zero. And that's why I think there's no such, but I think we have grown past that the startups were afraid to tell the business idea. But a couple of years ago, I still met someone who was afraid to talk about their business idea because they thought that it's going to be stolen. You can't steal the execution. Yeah. There are some cases, but I guess now it's, there was actually a recent case when we had to sign an NDA, but well. Yeah, an example, I think also, well, this is like super simple, but I think you all know Bolt, it's like the best example. When they arrived, this is like from their own blog, but I think this is the best example when someone says it's about the idea. No, they pretty much copied Uber, copy-paste. Uber was there in the United States, but I think this shows the thinking, how they actually adapted the same idea to the market. It was about the, let's say, yeah, you can read it's like how you can read it later as well. You'll see the blog, but it's pretty much the founders knew their market. They had some smart guesses about what's coming in technology sense. And I still remember how when they announced it here, they went through the taxi services. So completely opposite what Uber did in the United States. I was actually, I think in the US when Uber sort of was recently launched, they went all for the private drivers, no taxi services at all. Here it was the complete opposite. So I think that's pretty genius, and that's why they succeeded. And I think that's kind of something that we all look in the founders, this ability to be flexible, because it's not about, again, about idea. It's about adapting that idea to the market and to the customers and to something that works.
They basically both didn't go where the Uber was. I guess that was the right.
But they did.
Other things,
yeah.
Other things still hold.
Yeah. But yeah, so it's not that simple. But then again, how do you know? Like I guess this is nice to read now when you look back. But how do you know when they are just starting and they go to you and say, we're going to do the same thing to Uber, but completely different? And as an investor, you're probably thinking like, what the hell?
Their first investor story is quite unique as well, right? That the real estate company invested them rather than a actual investor, I would say. Yeah.
Yeah, because I think that at least, let's say, investors, and I'm thinking also from us as a fund, we have the obligation to return our fund to our LPs. So we are a bit more restricted than, for example, well, technically you, because if you're making decision on your own, it's your money, you can, well, at the end of the day, you can do whatever you want, but for us, and I think the risk, like appetite for us is definitely much lower. And I think this is important for companies like Bolt or someone who's actually changing the market. But okay, yeah, so this is the holy trinity for everyone. I think team, market, and product. And if you get the intersection, that's the perfect. But I think in reality, it's usually, you have, especially in the early stage, it's mostly going towards the team because, and a bit of the market, and I would say the product is the least important, least important at least from these three, because if that will fail, hopefully they will figure out something else. And with the market, it's kind of just figuring out, is it big enough, if the math is correct. Okay, I will go over, I guess a bit more quickly, because I don't know if you're good on timing. There will be quite a lot of text, but I know that I will share the deck with Emils and he will share it with you. It's more about how, giving you questions and some thoughts when you look at the startup pitch deck, what are the things that you need to check, what are the things that you need to think about, and this is usually what you get, the summary, all the different things in a classic pitch deck. And I guess this is a reason why startups also go in the same day. And this is what I also usually tell to the startups, that this is what they need to add to the pitch deck. Problem and solution. Here it's actually the biggest, there are quite a lot of questions on the screen, but I would say you need to evaluate and ask if this pitch is, if this problem is actually real or painful. Real and painful, or this is something that you call, it's called we call it like a painkiller or a vitamin. So if it's a painkiller, there will definitely be a customer that will pay for it. If it's a vitamin, then you have to think about different problems. Is it gonna how big is the pain? Does someone actually gonna pay for it? I think that's pretty straightforward. I don't know if I need to go into detail. The only thing that I would say, always try to validate the problem by yourself. So don't take the startup's word for granted, because of course they want to sell, and it's not like I don't want to say they're lying, but sometimes they're saying nice things, and they're also saying that, oh, customers love us. They might love us, but for example, we also do our due diligence, and sometimes we call the customers and they actually tell the real intent, which might be, yes, it's a nice product, but for example, we need at least a year to implement it. Or for example, we love it, it's definitely a problem, but in the scale of our priorities, this is not top 3. So, and sometimes I think startup founders, again, they're not doing that on purpose, but they're just sometimes so excited about their product that they're overestimating what the customers are saying. So, letters of intent, everything, and this is where exactly you don't really have the customer data. There's no, maybe they have 2, and that's what you have to work with, and you need to understand if 2 is enough or it's not enough. Solution, actually, I'm not touching, I'm not touching that much on the solution, because I think that's a pretty straightforward, if the pain is real for the customer, the solution is gonna be there. It's not, I think it's the easiest part of the equation here. Market opportunity, so this is usually what you see on the pitch decks. It's the total industry size, reachable segment, realistic share. This is that every startup inserts it there. Every investor asks for it. Both sides hate it, because it honestly doesn't provide anything. The startup feels the need to put huge numbers there. And then the investor always hears this oh yeah, the market is billions or millions. And then you basically check if it's enough billions. But I think that's still something that what actually matters is, I think, the market growth rate and fragmentation. How does the market look like? Is it is it growing? Is it declining? What's their entry strategy? Do they have a plan? For example, I usually like to check the go-to-market plan, because it's not even about the billions, it's about the logic behind it. You need to believe that it's with the big fluffy vision, everyone has it, but can you actually achieve it? And to be able to do it, you have to, the founder and the team has to make a plan that it's what are you going to do in the next 3 months? What are you going to do in the next 6 months? And how each of those steps actually take you closer to the big goal. It can be by geography, it can be by different let's say customer segment. And my experience, startups are usually afraid to put down such small steps, because they are afraid that the investor will come and say, what is this? where are my billions and millions, and why are you like not talking about those? But in reality, I think that approach, actually, if you tell them that yes, we know the billions, but this is actually how we're going to get there. Yeah, and the market, well, this is something, depending what is the market, I think this is where you kind of can talk to each other, you can talk to other experts, because even as investors, we are very generalist. We have to ask for people in the industry, their expertise. So this is something I actually suggest, and I think Business Angel Network is very good in that sense, because there are different experts, or you can find different experts also within the network and understand, because we're not super qualified to talk about specific market in the industry, so we need that information in our due diligence phase. Business model traction, yes, this is where the money comes in. Usually there's no money at the early stage. I think that's also mostly where there is some money, so this is where you actually figure out what are the revenue streams, or what at least they're planning, what is the pricing strategy. Ideally, well, the business model just have to, again, sort of, you have to check and understand if whatever they're asking makes sense. Is it, for example, I think always for the software startups, again, recurring revenue is the best, because that's something that you can sell again and again. If it's one-off or is it more complicated business models, that's where you need to kind of dig deeper and understand, is it realistic? And of course, then it's like if there is actually some customers, then you can check the key performance indicators, customer value, revenue per customer. Again, we get to use that part very rarely, let's say, I must say. That's usually we invest at the stage where there's a couple of partnerships, pilots, revenue, or no revenue at all. And again, yeah, verify all the financials metrics and check if the projections make sense. Usually we ask for the financial business model, what they plan. We don't ask for a 5-year plan, because we all know that goes to south very fast. But we do ask for something that it's at least 12 or 18 months, because they have to be able to live that long, because then remember the failing, why they fail. One of the big reasons is they can't raise the money, because they're caught in either they spend the money too fast and they can't reach the next stage. So I think for you as investors, it's also important to, it's not always a no, I guess, at least from us, if it doesn't match. But then definitely that's a discussion that you need to have with the company and say, hey, that for me to be able to invest, you need to figure this out, because it doesn't match.
Are you allowed to invest in the next round? Like to say like 12 to 18 months, so it's expected that you're going to be next round in most cases. But you as a fund?
As a fund, yes, usually, yeah. And I think that's also for the angels. So for example, you can, we invest, especially if we invest in the first round, we keep the rights to invest at least pro rata. Of course, if it's a successful round, then we want to invest more. So we want to add that that's something that we want to do. Yeah. Well, the worst part is if you don't invest in the first round and then 12 months later you understood that you should have invested. That's a bit more painful. Then you have to pay a bit higher price for your mistakes. But again, no one knows. This is a bit, you can just make, the more investments you make, I guess the more knowledge you get. But usually these are kind of the things that you kind of just, for example, for us, when we go through the process, we have our own internal CRM, we have the checklist, we try to, and I know of course for fund, we are a bit more process driven and there are structure. I think for business angels, usually it might not, you don't have that need, let's say, to report to someone as we do. But I think it still gives a good understanding if you try to build this checklist, how you look at different metrics, how you compare startups to each other, and then you can start seeing also the trends, because, well, it's especially if you look at the many companies in the short period of time, there are different changes, and you need to have like the benchmark as well. This is the most important slide, I guess. Honestly, I would say that this is where you have to spend the most of the time when you're evaluating the company. If you're investing in in the early stage, even with certain revenue, this is something that usually goes. This is the how we do it. For example, we always have at least one meeting in person, and ideally with all of the founders. Not always, or at least we make sure that all of our partners have met with the company. We do team Q&A because there are different things and there can be several meetings. And I think for you as well, it's of course there is like if they have industry experience, if they have complementary skills. I think that's a bit more straightforward. You need to understand if they can build the product, if they can sell the product. But honestly, sometimes it's about the team chemistry, and there where you need to evaluate more of the sort of, it's a bit more soft skills, but I guess that sometimes gives us a lot of information if the startup can be successful or not, is how do they interact with each other. We always try to guess if we can learn from their meetings if they're gonna go into the argument. Sometimes it's their, the classical thing, for example, there is an idea author who is usually the CEO. At least 50% of the cases, that person has no business being the CEO. They can be a visionary, for example. They can be a product person. They can be a technical person. But just for the CEO role, they might not be the best characteristics. Then what you need to do is it still might be a yes on the investment, but you need to understand how flexible is the team to adapt. And are they willing to actually put aside their egos for the sake of the business? Because again, you're sort of investing in the team, but in the team's ability to build the business. And
what do you think about this new trend of solo founding?
I have a red flag slide.
Okay, nice.
That's the first thing there.
Maybe that's a little bit old school.
It's not a clear no, but from my experience, building a company as a solo founder, it's super difficult. It's not impossible, just to say that, and it can be done, but I think imagine you have to probably build the product, you have to manage the product, you have to sell the product, and then it's possible, but then I would say as an investor, you definitely have to spend a lot of time with that person to make sure that they can do it. As a baseline, I would say that's very, it's a red flag, it's not a clear no. You can deal with the red flags as well. But then I would say, I would ask, for example, what are the steps, for example, how the person is building the business. So what happens, what exactly is their expertise? Who is going to help them with the tech side if they're not tech? What happens, this is also maybe on the tech side, now I guess everyone can build with vibe coding. You don't even need developers. Depends on the startup. But if you're building something with more heavily tech side, then it's as a single founder. Usually you either have someone hired, but how do you manage the team? Is it something outsourced? What happens if those people leave? So this is where the founding, because I think the difference between the founders and employees, you all know, it's like the motivation and actual, how likely are they to stay if someone offers them a very highly paid job? Because for them, they need to actually stay and work for it. And if you are single and, for example, a solo founder, and then your team is poached by a big company, what do you do? Can you pay them? Probably not. So I don't know if that answers your... It's not a clear no, but then I would say there's quite a lot of the list of questions. What else? Execution ability. So I think this is something where we usually run reference checks. We have called previous workplaces, colleagues, startups, teammates, especially if you see that there's failed startup. We usually reach out just to understand what happened, and but I think that's part of the process. And again, yeah, I think early stage investing, this is 70%, like all the rest, like there's many more slides actually on the other things, but honestly, I think this is the most important slide and the most important part because, yeah, for example, from my Wise Guys times, we have had companies where we invested in them. They failed because they got into the argument, and we also had companies where we have seen founding team, they failed one company. For 1 year, the company was pretty much, we called them a zombie company. So it's sort of not bankrupt, but they're not doing anything. It's just existing somewhere. Year or year and a half later, the same founders, same company, they actually figure out something and they start again. Same company, for us as investors, amazing. We thought that it's going to be like, you know, lost money. But it's all about the team. And again, that's why I'm saying, like, it doesn't really matter. Also with the Bolt example, the team is the most important part because whatever the market throws at you, most likely you have to be able to adapt. And with the product, again, with the vibe coding and all, like the AI, you don't even have to, at this point, if it's not super complicated product, you should be able to do it if you know what exactly you're building. Yes, competition differentiation, this is where you kind of dig deeper because this is usually where a lot of startups also fail. So what happens if there's, how are you better than competition? And here, I guess, especially if you're now, there's a lot of AI startups that's very, very important because now we've seen quite a lot of them building the same thing, you know, and there's like, I think, I don't know how many AI agents live out there. The question is why your company is going to be better. And then, for example, with AI, there's also come OpenAI or whatever Google or Gemini opens, sends out a new product that kills like a bunch of the startups. So how do you as a company actually operate there? Is anyone can just throw millions at it and then they buy all your users? And this is, honestly, it's you can check it with the market, you can check with the industry experts, but at the end of the day, this is where the founders actually have to tell you why. And they have to convince you. Thoughts, questions? I see serious faces.
Would you rather go for 18 years old or 40 years old in your team, or is there some kind of ideal mix, or what do you want for everybody the same age?
Depends. Honestly, I think the age is not that relevant. I think it's rather what experience or what skill sets the 18-year-old or the 40-year-old has, and what kind of company it is.
Would you believe more in first-time founders or seasoned founders?
Usually seasoned founders. You know, but that's also a bit. It depends. It's a good question. Yeah, it's a good answer as well. I know. Everything that I say today, the real answer, it depends. I think we are actually evaluating that, and I think, for example, first-time founders have their definitely benefit, the passion. We have seen those companies, but for them we pay extra attention to the execution. Can they actually execute? Do they have good advisors in the industry? Because most likely, first-time founders, especially if they're 18-year-olds, they don't have an industry experience, so there will be a lot of mistakes that they will make just because they don't, like, you just learn certain things by doing them and failing at them. For experienced founders, I think in general that's a good sign because that means that you can build a business. The question is, if you fail once, that's a very valuable experience. If you fail twice, you can look at it. What happens if you fail 5 times or more and you still keep building the business? So then I think it's a... Exactly. But
so your point is that at some point, you know, this experience of failing is not valuable anymore.
It's valuable. I guess it's we need then to check what is that person trying to build again. Are they trying to build again the same thing or similar thing? Which then it's like, you know, at some point if you try to do the same, fail 5 times and then try the 6th time and try to expect different results, then you know it's the saying, it's not great. If you're actually talk to the person and understand that they have changed the situation, you believe that now that this is the time, then why not?
You have made 6 investments so far. Which out of these 6 investments do you mostly believe in and why?
Oh, well, now as we made them just this year, I would say all of them. Well, I have to. Otherwise, it's a bit. But we already see some of them have different lessons. Well, I can share one. I think the Latvian company that we invested in, and I think because it's also public and it's not a secret, so we invested in Handwave, which is a Latvian company that are doing the palm biometric scan. So currently they're going also for the bigger markets, so we have really high expectations. So that's also a case where when we put 500,000 in there, just so that's also not, so we put quite a big ticket and we believe them and we'll see. But of course there is a big chance that they will fail. Now we hope that not, because they have done all the homework. They have worked already for 3 years. They have the prototype, they have the market, they have talked to all the customers, they have all the chain, let's say, ready. How do they interact with them? And I hope we will see in 2 years. Okay, I will move. Yeah, and scalability and exit. So this is something I'll go also a bit. So this is something we kind of try to understand right away, even though sometimes it's very difficult. But I think it's at least understanding, is it usually, that for the startups, the exit route is acquisition. So very rarely they go to the IPO. Sometimes it's a merger consolidation. But I think it's important to start, and this can be also good for when you make an investment decision, especially now, for example, with all the AI plays and everything. I think it's smart to start understanding how can you, well, I don't want to say how can you get rid of that startup, but technically it is what it is. Because if they're successful, then there will be a way to get out of the startup. But if they're somewhere in the mid-market, you need to at least start thinking about the backup options and start thinking about how to maybe get them already early on. For example, some of the startups from the Wise Guys that actually exited, they all told the story. I remember one of them, one of the first actually Wise Guys exits, he always said that he knew where he's going to exit. I think 4 years before he even exited, because he was very consciously going to different meetings. He was building this weather forecast app and for agriculture, and they got acquired by one of the Monsanto subgroup companies in US. And he met basically one of the guys in some hackathon who introduced them to this Monsanto subgroup venture arm. They invested in their next round a small ticket, then they kept in touch, and they knew that at some point, so basically then they acquired. And I think that's also for you when you make a decision, is to understand how can you strategically already think about where to put it, because I think we can't really afford to think it's just let it be and hopefully you'll be unicorn and succeed.
With scalability, isn't it that matter of fact that the business, from the very beginning, has to be in the US to be scalable nowadays?
No.
No.
I think it depends. Well, ideally, of course, in the big vision, you go for the whole world. I think realistically, it's very hard. Usually, how we look at it is you scale for it's either Europe, either US, or now there's also, let's say, Middle East, Asia in play.
With Europe, it's always challenged with different languages and legislation. That's one kind of.
It is, but it depends on I think what the company does. Sometimes it's easier because with the US, I've been there. Well, it's a long time ago, but for example, then it's easier than before. But we still see that if you want to sell in US, you have to be in US. It's very hard to do it from here unless you're super specific, let's say, industry or niche company. But even then, you have to be there. I think if it's like a super B2B I can think of some that are very specifically going for that. They can sell both in Europe because, for example, they sell to huge enterprises. Then it doesn't really matter. But then still, if you want to sell to the US enterprises, you actually have to have like a business representative. And in early stage, the business representative actually means one of the founders, because why would they talk if you're not a big company? They're anyway giving a huge step into believing your product, and that's the thing. Like, for example, one of our investments, the Estonian company, Estonian founders, they also sell in US, but they are there because they have a person from the team there. They very often travel there, and they don't even look at the Europe. So I think the question is exactly understanding what they do, and then understanding what can you do with the resources you have. Because if you have a team of 5 to 10 people, there's limited, and usually limited amount of money as well at the early stages. Yeah. And here, I guess if you evaluate what we usually do, again, we just look at the market, what has happened before, we look at different reports. Good on time? Okay, quickly. Funding ask. This is the most, this is a slide. Usually they give, usually they give you some number. They tell what they're going to do. Usually it's, I don't even know, it's like 40% for development, 30% for marketing, the rest for the operations, which doesn't even give, at least for us, it doesn't really give me anything. Usually what is the best question to ask is, again, this 12 to 18 months of runway, how they are planning to spend the money, and what they're going to achieve, because this is where you think about the next round. Because I think, again, you have to, the main goal, at least for us as an investor, is to, if we give them money, we need them to unlock the next level. And then what helps for us usually is to understand, even if we invest in the pre-seed stage, we can do the follow-on investments. We cannot then be the lead investor in the next round because we cannot price our own company. So what we are doing, we're actively networking with the next round investors, understanding what they need to have, what they need to see in the startups when they invest. And then when we actually do the investment decision, we take this into account and just check if whatever they're trying to build makes sense. And is it realistic? Because then, well, sometimes we've seen the companies, and it's usually, sometimes you don't need that much money to build something. You actually can get to the traction. Sometimes whatever you're building, you can't do it with properly with $500,000. You actually need those millions, but then you need to understand which case is which. Yeah, the famous red flags. Solo founder, no founder full-time, uncoachable team, no clear customer validation, broken cap table, unrealistic financials. I guess those are the most, yes.
Actually, I have a question. I mean, if in this early stage you maybe meet with the founder, maybe talk to them, maybe, I know, 3 times, I would say, how do you know if he or she is uncoachable? Like, do you do like, make them fill out some type of, scientific surveys that kind of identifies what type of persona they are, or
No.
whatever?
You talk to them. No, it's easy as that. Usually we try to, well, not on purpose, and it's not like, you don't have to be a mean person, but I think it's just, you can tell from the conversation, especially when you as an investor try to give a suggestion. The worst, and I've seen them a lot actually, it's not an answer that you would expect an answer, okay, thank you. Why do you think that? Can you explain a bit more? It's interesting. We have seen, especially in the acceleration a bit more as well, it's like the answer is, no, but I'm doing this because of this, and whatever you say, they're just not listening. And I think this is the problem, because it's going to be very hard. Like, they're not going to listen, and you can't even coach them. And then it's you have to, again, it's a red flag, it's not a definite no, but I think then you have to believe the founder very, very much that whatever they're doing is the right way. And you just give them the money and let them be and hope for the best. It still can be good investment, let's say. Should we do the exercise? because then, okay.
We can take 1 or 2 examples.
Yeah, we can maybe do. This is, I'll tell you, I asked the ChatGPT to make a couple of exercises of very short, based on the Baltic market and companies in the Baltic. So we'll see. So mind these. Health tech, business to business wellness, helps companies support employee mental health through a digital platform, offering daily check-ins, stress management tools, and quick therapist chats. They have 5 pilot customers in Baltics. They're priced like 3 to 5 euros employee per month, and now they're raising 400K at 2.5 million pre-money to expand to Nordics. What do you think? Would you invest?
No, there's gonna be problems with regulation. Whenever I hear like medicine therapist, soon there are gonna be some watchdog coming in and saying that you simply cannot do that. Especially when you allow like AI to work for do things like which are like medical. Well, that's my take.
Yeah. Anyone else? This is actually not, they're not designed to be very specifically good or bad because it's...
So basically the revenue is 3,000, right? And the valuation is 2.5 million?
Yeah.
Impressive multiple.
Yeah, but that's the first round, you know. What about now? So there is a team.
Yeah, all the red flags.
Again, this was not me. I gave it fully to ChatGPT with some.
I know the team seems weak.
But there is an advisor. But they have 5 pilot companies. How do you know
That's
it's
a
not?
lot.
I'd give them KPIs for the next 2 to 3 months to show how that they work.
No, I'm gonna be interrupting
400K.
themselves.
I'll go then. Oh, someone.
You have to talk to the team, no?
Yeah. Okay, if it's too cheap, how about this? AI fleet management software for different, you know. 6 paying customers, 10K MRR. There's growth. But there's 6 money. Like you said, it was too cheap. Now it's 6 million pre-money.
Actually, it's pretty nuts.
The team is still 70%, so we just see the team.
Yes,
There are-
but like from this, you would be interested to talk.
But how many these fleets are there?
Wild guess?
It's
I think they maxed out their potential clients, no?
could be.
They already must.
But okay, I will give you a next hint.
These guys don't need seats.
I'm looking at Jan's facial expression now. He's like,
So this is, I wonder why they are like approaching you.
yeah. But what do you think about this team?
Seems much better.
Solid.
I can see why they're raising so much.
Why at that pre-money? Okay, any other comments? This is just like, you know, again, there's no right or wrong answer. This is,
These are usually very intensive businesses, right? So scaling. But they are just software. Okay.
I think software. Infinite scalability. Clients are
It's like
evidently.
penetrated market.
We have seen quite a lot of similar startups actually during the time because of AI and fleet management. I think, I don't know, really a lot.
If you cross out this AI buzzword, then there should be like competition to this one, or and I don't see how they will look vis-a-vis the competition. That's kind of missing part here. Because if you're like competing with established player with billion revenue, then it's quite tough. And AI might not be your advantage because those guys also have access to AI.
True.
Well, the CTO one doesn't really show a green flag, but prefers building over meeting customers. How can you build something if you're not listening to them? Yeah.
True. Sounds good at first, no?
Yeah.
All right, I'll give you then the third one, maybe. Digital identity startup provides e-signature ID verification.
We have talked of it already. Apps. So why do we need more?
We had such very similar characteristics at this recent fintech event conference.
Yeah, well, I'll give you, the team right away as well.
Sounds like it.
So, COO, slow in execution, right?
Slower than okay.
Again, wasn't me, just
Well, to me, this looks the best out of three.
Okay.
I would agree.
It's like, many clients, some traction, some growth. The valuation is not, not necessarily so stupid. And the team is there.
Okay. So you accept one of the fake startups at least as a group. Well, technically it's not, I gave there is some similarities with a lot of startups actually in the market. Not the numbers, so the numbers are maybe a bit different. So.
I have a question. When you figure out that the COO is slow in execution, how do you treat that?
Depends when you figure it out. Hopefully
Before investment.
Then you can put that as if you still like the team, if you still like the deal, if you still think that there is a chance, that's something you talk to the team and understand. Well, maybe you don't point out and say, well, you are slow. Maybe in a nicer way, but I think it's something where you say that, okay, we want to invest, but we're very cautious on this execution speed. We need to see a clear plan, for example. How would you mitigate this risk? Well, if it's, for example, sometimes we also deal, it depends if it's a founder or if it's an employee. If it's an employee, then it's a bit easier. You talk to the founding team, explain your concerns. Of course, at the end of the day, it's the team's decision, but then that's actually your task as an investor as well, to support them and provide this extra perspective. But also it's not just saying, oh, they're slow, but it's also kind of coming up with the plan how you can mitigate. We have helped companies to find, let's say, board members, mentors or coaches or employees as well to support them. Okay, well, this was, I guess, I think this is something maybe I know that you also asked a lot of questions we can quickly go over. But of course, the valuation, investor ownership, potential return, if affects the dilution, everything. But I think another important thing that you have to think it's how do you actually determine the valuation? Because there will be a couple of slides, but again, here you don't have the numbers. So there are not really any reasonable data how you can detect what is the real valuation of the company. If you go too high for the value, and of course that's what founders want, but honestly I think in the reality not everyone, sometimes they don't even understand. We have seen a lot of later stage investors coming in and saying that the first round was raised with such a high valuation that it's nearly impossible to raise the second round. Because the rule of thumb for the startups is that the next round should be with at least twice as high valuation as the previous round, because otherwise it sends a wrong signal and it just doesn't, let's say, work in the industry. But of course, if you go too low, then either you don't get the deal, but then you can also create, even if the founders end up taking the deal, you will end up with a lot of grumpy founders that honestly dislike the deal. And it's hard on the cap table as well. So again, a bit fake numbers, but this is something that goes, you can see that I think when you go for the valuation, it affects a lot of things. It's not only the value, it's, well, technically you come up with a valuation like that. The wind blows from here around 4 million. But again, I think when you think about it, there's like an Excel behind it, and you have to think about, and that depends a bit on the startup as well. So you see that there's like usually pre-seed, seed, series A, B, C, hopefully the exit, let's say to 200 million. And then you start understanding where also the founders. So usually the classic, let's say, dilution that the investors take from the company is somewhere between 10 to 20% each round. So when that you put that into the Excel, you start understanding how much actually equity stays with the founders, and that has to be a certain amount, because otherwise you want the founders to be motivated, because honestly they're doing most of the, let's say, work, and if they're not motivated, at some point you will just lose them, and they will there's no motivation for them to continue, because it will get hard at some point.
What about dual class shares? When you can lay out little percentage, but on the other hand, I mean,
Yeah, sometimes.
because this is kind of solved the issue. I think you might have
Yes and no. Well, this is very simplified version, let's say. In reality, it's usually you start seeing a lot of exactly like you start seeing, and I think you will have terms and negotiations with all the different terms when there's like liquidation preferences and all those things. It gets super complicated. But I think it's very important to kind of understand how you negotiate the valuation and also what implications it does. Of course, investors want to have it as low as possible. Startups want to have it as high as possible. But it's there is some reasonable way. Yeah, this is, for example, based on the previous one. If you invest 50k euros in pre-seed as an angel, you own a small amount. And then you can see the multiple, for example, what happens with the previous numbers, let's say, how that also changes. And I think this is like, well, if you're lucky, like let's say that the 200 million exit was gives you 24 times multiple, which is amazing. But again, simplified, there comes different things into the play. But just you to understand what can it be. And of course, if it doesn't, it not like there's nothing. And I think this actually, and this is I think where Antis probably will talk about the portfolio, is like, this sounds amazing, but if you put 50k and you get out like 1 million, but if that's the only one, but you actually do 10 or 15 more investments, then you know the average is a bit different. But this is, I guess, how do you actually figure it out? What we use, because we are in the same boat, comparable deals, you can just benchmark. So for example, there is this Baltic startup report. You can see the average median valuations for the startups. I think now it was 4 million pre-money valuation, median. But of course, what we usually as a fund as well do, we kind of adjust it with the, and that's why what we talked before. So the team, product, market, we actually have a scorecard where all of the partners, we put a lot of information, we rate each deal. And then we sort of adjust if it's like the, and again, the 4 million, technically, it's figured out by, there's no real data why it's 4 million. It could technically be 5, 6, 7 if the market agrees, because you can also see how the valuations are changing, because at the end of the day, if someone else is willing to pay the price, and if there's more, and we see it quite a lot happening in the market, that the deals are getting very competitive, that we have to be, and that's where the rest of the sort of more softer support comes in. How can you help the company? Can you actually support them? Do they like you? Do you like them? Because at the end of the day, we've seen quite a lot of funds as well, especially, you know, fear of missing out. Everyone in the investment industry loves it, because it showed them something with AI. There's like, everyone is on it. And the problem starts when we have also seen that there are quite a lot of, especially the hype deals, when we've seen the cases where founders start with, I don't know, the 3-4 million valuation, they end up getting 10, 12, 16 with the same pitch deck, same product within 3-4 months time period. Method? Nothing. It's just. But I think that's something also important. Like for us, actually, where we come back to this is, and I think this is the important part, you have to play the game as well if you want to be part of the good deals. Because again, if the good deals are good, then they will bring a lot of value. But then we also think about this portfolio diversification. It's sort of, we always try to reverse engineer also from the exit value and potential and see what actually makes sense. And then you can start understanding what makes sense, what is the price you're willing to pay. And sometimes, of course, you're paying a bit higher price for a good team, better deal, but it still has to be reasonable. Otherwise, it's just, let's say, marketing cost at the end of the day. But I think that's, well, negotiation principles. I don't know if I have to go over. I'm sure you probably have, but this is something, again, this is where you just go and talk to the founder, and I think this is the soft part. Again, if it's a good deal, most likely they will have to also choose you over other investors. And I think that's a very good thing to keep in mind, because it's always, I think, in the ecosystem, there's always this myth that, investor is there and the startup is always trying to get the money. In reality, both sides need each other and need to have the best deal as well. And I think that's it from my side. Oh, cap table. Should we? No?
We will have a topic on it later.
Yeah, but I think that goes together. Is just keep it as simple as possible. I guess that I can say. Yeah, the only thing that sometimes people forget is the convertibles on safes. Before they are converted, they don't show up on the cap table. You have to be careful to see if the founder actually tracks them. But I will stop. Thank you.